Hello, I'm Loda Smits for the Finance News Network, and joining me from AMP Capital Investors is Head of Investment Strategy and Chief Economist, Dr. Shane Oliver. Shane, welcome back to FNN and Happy New Year.
Thank you very much. Hope you have a great new year too.
A year ago, you told me you saw the ASX 200 pushing up to the 5,000 level by the end of 2013. And that's exactly what happened. So Shane, what do you see for the year ahead, and where do you see the key ASX 200 index sitting by the end of 2014?
Well, the bottom line is that I see further gains in share markets over the course of the year ahead. And there's several reasons for that. Fair enough, the market's not as cheap as it was a year ago, but against that, my feeling is the Australian economy will start to pick up pace. We're already seeing that in the housing sector, and I think as that flows through, you'll see retailing start to pick up as well, and eventually investment outside of the mining sector. So I see growth picking up. That in turn, I think will drive stronger profits. At the same time, we're going to have very, very low interest rates, both globally and in Australia, and the combination of all of those things I think will push the share market higher, probably up to around 5,800 on the ASX 200.
Now, you mentioned low interest rates. You told me at the beginning of 2013 you saw the key cash rate moving down to a record low of 2.5%. And again, you were right on the mark. So Shane, where do you see the key cash rate moving in 2014?
I think the Reserve Bank will leave interest rates right on hold through the course of the year, with possibly a rate hike or two towards the end of the year. So by the end of the year, we're looking at the cash rate maybe around 3%. So on hold, 2.5% for the bulk of the year, then a rise as we come into the end of the year.
The Australian dollar remained stubbornly high throughout last year. What do you think the local currency's fair value is, and how long will it take to get there?
Well, I guess in an environment of strongly rising commodity prices and a strongly performing Australian economy, as we saw most of last decade, it was appropriate for the Australian dollar to go higher. Now we've got a situation where commodity prices aren't as strong as anymore, and the trend, if anything, has been a bit down. And on top of that, the Australian economy hasn't been doing as well. And that all points to the need for a lower Australian dollar. So we have seen it come down a bit. I think we're going to see more downside over the course of the next 12 months, probably taking it down to around 86 cents by the end of the year. But fair value on my measures is around 80 cents. So the bottom line is we've still got a fair way to go before we can say that the fall in the Aussie dollar is over.
And should the Australian dollar fall as you expect, which sectors could bear the brunt of the pain and which may get a boost?
The big performers over the last few years have been particularly the high yield parts of the market, you know, the banks, and then you go back a while ago, Telstra, telcos, utilities and so on. The past year's been a bit more messy. 2013 was a bit more messy. But my feeling is as we go through the course of the next year, a lot of the focus will shift to the relative underperformers. Particularly I'm thinking of resources stocks, both mining and energy stocks, industrials. So we're coming into a phase where the deep cyclicals, if you want to call them that, will really start to outperform as the cyclical backdrop globally and then eventually in Australia starts to pick up.
So Shane, what do you believe are the biggest risks to watch out for in the year ahead?
My feeling is that the biggest risk is probably what we're also watching over 2013, and that is that after a massive rally in bond markets where bond yields were pushed down to very low levels, that at some point investors say, well, I can't see the returns in bonds anymore. They pile out of bond funds, particularly sovereign bond funds, and go into other investments. And in the process of piling out, that causes a sharp upwards movement in bond yields, threatening global growth and then maybe even the share market. So I think that's the biggest risk.
And which assets are you overweight or underweight?
Well, right now I think the main opportunities are in international shares. A decade ago I thought it was Australian shares, but now I think we're in an environment where traditional international markets like the US, Europe, Japan are looking a lot more attractive. And that's where I see continued strong gains, and we're actually overweight in our funds, international shares. Australian shares, we've got a sort of a neutral to mild overweight in. We see gains there, but they may be relative underperformers compared to global shares. We also like share markets in North Asia. The Chinese share market, always hard to tell when that one's going to turn around, but overall the Chinese share market looks pretty good. And you've got a bunch of other markets in North Asia, such as the Japanese market, good recovery story coming through there, and of course Korean shares, which remain very cheap. So apart from those share markets, the other area where we've got fairly solid positions is in commercial property. I think we'll see continued good gains out of that sector. and also infrastructure assets.
Shane Oliver, thank you so much for another yearly outlook and all the best for the year ahead.
My pleasure. Hope you have a great year as well. Thank you.